Welcome to the Relative Sentiment Report video update for June 26, 2024. Today's update will be a little bit longer than usual. It'll be based on a market update presentation that I'll be giving tomorrow. It didn't make sense to create two sets of visuals, so I'll be using that presentation for today's update. So just warning you ahead of time that it is a little bit on the longer side. So let's jump in. So today we'll give an executive summary, talk about the secular big picture, touch on the current macro backdrop, have an asset class overview, talk about our preferred positioning, and then close with a brief summary. So the executive summary is that we're in a secular bear market. That continues. It's likely going to last at least until the end of the decade, if not into the subsequent decade. However, inflation currently is not as big of a concern as it has been in the previous months and years. Growth, on the other hand, now it appears fine on the surface, but if you look at how the market's behaving, the market's behavior actually says that growth isn't as fine as it otherwise appears. So that's a little bit of a conundrum. If we also look at the recent equity market behavior, it's astounding in how it's been outside historical norms. We're seeing extremes that have never been seen before in the relative outperformance of, say, the Nasdaq to the Russell 2000 and other metrics of that nature. Now we're also heading into a very bullish seasonal period for election years. July is quite bullish. The Nasdaq has been higher 16 consecutive Julys with an average return of 4.6%. June, July, and August tend to be the most bullish 3 months of election years. Institutions have been buying equities as of late. Composite equity relative sentiment is turning bullish. So things are lining up for the market to continue higher, but there is also reason for caution, which we'll get into. So to give an overview of the secular big picture, if you've read some of my newsletters or if you've heard me in the video updates, it's my contention that we're in a secular bear market driven by high inflation. And I'm sure people who aren't familiar with the definitions of secular bull and bear markets might say, well, the equity market is making new all-time highs every day. How can we possibly be in a secular bear market? Well, the definition of a secular bull market is one that outperforms inflation by double digits. So if you look historically in the US from 1800 onward, during secular bull market periods, equities have returned 12% over and above inflation on an annualized basis for 10, 15, 20-year periods in a row. Whereas secular bear markets, equities just keep pace with inflation. In the from the mid-60s to the late 1970s, early 1980s, we had a secular bear market where equities annualized 5.5% from 1965 to 1982, but inflation annualized 7%. So you lost 1.5 percentage points relative to inflation on an annualized basis for 17 years. We also had a secular bear market driven by high inflation right before the Roaring 20s. And same thing, equities went up, but inflation went up more. So since the end of 2021, the equity market in the US is just keeping pace with inflation. It's up 11.5%, inflation's up 11.5%. But in order to just keep pace with inflation, the US equity market has had to take on bubble level valuations, which likely won't sustain. So that means equities will probably pull back while inflation will probably continue higher. So the US equity market will probably begin to lag inflation in the coming years. Excuse me. Now, what are the drivers of the secular cycle? Well, we have a sovereign debt bubble. The Fed really can't raise rates high enough to tame inflation. They probably don't want to tame inflation because the US fiscal situation, our debt requires inflation to inflate away the debt. We've had years of underinvestment in commodity capacity. We've had an abrupt transition to clean energy. The rest of the world is trying to circumvent use of the dollar in bilateral trade. The West is alienating the non-West. We have the situation in the Red Sea where the shipping lanes are closed, which adds insurance, fuel, labor costs to transported goods that have to go around the Cape of Good Hope at the southern tip of Africa. We have deglobalization, so bringing supply chains back onshore where the labor costs are higher and other costs are higher. And we also have tariffs making a comeback now. So the US, Europe, Canada are all looking to slap tariffs on Chinese electric vehicles. So all of those things, and not to mention the possibility of World War III, will keep inflation elevated likely until at least the end of the decade. These secular cycles tend to last a minimum of 9 years and up to 20 years. So if this started, say, at the end of 2021, you're looking at, at a minimum 2030. Now, the likely outperformers during this secular cycle will be gold, commodities, energy, material stocks, miners, Bitcoin, emerging markets, etc. And if we look at how those assets have performed since the end of 2021, so this candle chart here is VTI, that's the Vanguard Total US Market Index. It's up 11.5% since the end of 2021. Gold's up 24%, commodities are up 29%. XME is the metal and mining industry, it's up 30%, Bitcoin's up 35%, XLE energy stocks are up 63%. So the assets that you would expect to perform in a secular bear market driven by high inflation are precisely the assets that are outperforming. Okay, and if we look here, this gives you a color-coded view of the secular market cycles in US equities since 1926. These secular market cycles are driven by either earnings growth or inflation, and you have a secular bear driven by low real earnings growth, which is followed by a secular bull driven by high real earnings growth, which is then followed by a secular bear driven by high inflation, which is then followed by a secular bull driven by disinflation, and then the cycles repeat. So we had blue, red, green, orange, blue, red, green, orange, which I think is fascinating, and that holds way back to the 1800s as well. We've had this alternation of cycles. So there's a deeper meaning there about the business cycle and long-term economic cycles for these patterns that keep repeating themselves. But this is the total real return of the US equity market. So it's the equity market divided by the headline CPI. So whenever this chart goes sideways, that means that equities are just keeping pace with inflation, and you can clearly identify the secular bear markets. So here we had a secular bear market during the Great Depression driven by low real earnings growth. Here we had a secular bear market driven by high inflation. That was from 1965 to 1982. Here we had a secular bear market driven by low real earnings growth. The dot-com bubble earnings vaporized. The great financial crisis earnings vaporized. And now it's my contention that we're in a secular bear driven by high inflation. The inflation's been high. The assets that you would expect to outperform are outperforming. The equity market's barely keeping pace with inflation. All the elements are there for this to be a secular bear driven by high inflation. So now let's look at the current macro backdrop. So inflation has been pretty much the main driver of this secular cycle, but we've had 2 consecutive benign/favorable inflation prints. Oil and gasoline are well below their April highs, gold is off its highs, interest rates are lower. All of those suggest that inflation is not a near-term concern. In our last market update to this financial advisory group, we had mentioned that inflation might look as though it's coming down in the subsequent months due to how it's calculated. So there was a thought that owner's equivalent rent in the inflation calculation is in that calculation with a lag. And if we look back over that lag, owner's equivalent rent, people thought it was coming down, and that in subsequent months it would come down even faster, and that would drive inflation lower. Well, we did have a favorable inflation print last month, or this month. May's report released 2 weeks ago. Inflation came down, but not because of owner's equivalent rent. It was because goods prices kept deflating, and supercore services ex-housing was also negative. Now, inflation was positive, even though those 2 components were negative, which meant that owner's equivalent rent was meaningfully positive, which was not what people expected. They expected it to be lower than it was. So, goods deflation and supercore services ex-housing deflation likely won't last forever, so we will probably need owner's equivalent rent to start coming down a little bit faster for inflation to start going closer to 2%. Now, even if it does, given all the forces that are acting during the secular cycle, it likely won't stay at 2%, but there's an election coming up, and I'm sure that the powers that be will do everything they can to get inflation down in the next several months, so we probably will continue to see cool inflation prints. Now, the person to go to if you're interested in analysis about inflation is Michael Ashton. You can find his stuff at investing.com. He was I think he was the first market maker for inflation derivatives. So he really knows his stuff when it comes to inflation, and he has good summaries after every CPI report. So this was a slide from the last call where we had mentioned that everyone was expecting the owner's equivalent rent to start coming down, and that would mechanically make inflation look like it was going lower, even though the real-time owner's equivalent rent was starting to tick up. Now, we did get a cool inflation print, but it wasn't because of owner's equivalent rent. But this was what the thought was 3 months ago or 2 months ago. So now, when it comes to growth, so on the left we have the Atlanta Fed GDP Now GDP estimate for the second quarter. That's the most recent one, and it's sitting at 3%. So that seems to be pretty robust growth. If inflation is 2.5%, 3%, with real GDP of 3%, nominal growth is between 5.5% and 6%. Now, on the right, this was from the last call, where this tweet basically said that the White House, because the Fed was on hold with interest rates, it didn't look like the Fed could lower rates, because of the inflation reports that had come in up to that time, that the White House was going to ramp up spending. Janet Yellen, Treasury Secretary, was going to use short-term debt as opposed to long-term debt to keep long-term interest rates lower and not to create excess volatility in the bond market, which would then seep over into other assets, and they don't want that in an election year. So this was a tweet a few months ago, and we actually have seen some of this, these machinations come to fruition. First, let's take a look at, as an indication of growth, the number of travelers going through TSA checkpoints. It's actually at an all-time high as of June 24th. So that would suggest that the economy is strong. I got this chart from Jim Bianco on Twitter. His contention is that traveling is the first thing that goes whenever the economy starts to soften. So if you're traveling, people can cut that out because a lot of it is discretionary. But yet travel's at an all-time high, so that would suggest that the economy is strong. Now, maybe the economy is strong because of potential government shenanigans. Here we have a tweet by Brian Westbury. His contention is that the Treasury is basically doing a quantitative easing light by taking the Treasury general account and spending it into the economy. They spent almost $240 billion in May, which most likely juiced risk assets and it also kept the economy doing fairly well. And then on the other side, we have a tweet that talks about how the Biden administration has been artificially suppressing oil prices, and that this will have repercussions later because, as you can see from this tweet, the U.S. oil rig count has been falling, probably because prices have been suppressed and it's not economical to have as many running. And now that's possibly one reason why inflation is likely to reemerge, because at some point there will be some geopolitical spark, or just demand will pick up and we won't have the production capacity online, and that will probably likely lead to higher oil prices. Oil and commodities are in secular bull markets, so these secular forces will be conspiring to support those assets through time, and this is probably one of the reasons why that will happen. Because of the artificial suppression of prices now will lead to higher prices later. Now, growth on the surface looks fine, but I'm starting to wonder, is it truly fine? Is it really strong? And the reason I ask that is because the market is essentially screaming that it's not fine. The dollar's rising, that's a risk-off scenario. Long-duration bonds are rising, that's a risk-off asset. Stocks are falling. If you exclude the top 3 to 7 stocks, NVDA, Microsoft, Apple, Amazon, Tesla, etc. If you exclude those, stocks are falling. Pretty much, most of the sectors, various countries have their equity indices have fallen in the month of June, while the S&P is up almost 4%. Gold is outperforming silver and gold miners, which is also a risk-off characteristic, and commodities haven't really been strong. They've kind of been chopping around and a little bit on the weak side. They're down significantly since April. So I have to wonder, is growth really as strong as the headline equity indices and the GDP number would have us believe. And if you look at the economic data surprises, this is at its lowest level since 2016, which means that economic reports have been coming in and they've been less than expected, lower than expected, weaker than expected, softer than expected. And the market is actually corroborating that with how it's behaving. And we'll get into sort of the relative performance between the Nasdaq and other aspects of the equity market, which are at really historic extremes. It's pretty astounding. Actually, we can do that now. So we're going to look at Nasdaq versus the rest. So now this is a chart of the Nasdaq 100 over the Russell 2000. So this is QQQ divided by IWM. IWM is the Russell 2000 ETF. QQQ is the Nasdaq 100 ETF. Now, this is a chart from the last market update call I gave in April. And you can see that that ratio was just content to be in this long-term channel. It's dated back to 2018. It hit the top of the channel. Tech was a crowded trade. Small caps was not a crowded trade. I thought, hey, crowded trades tend not to pan out so well. And you want to go where there's a vacuum and wait for people to come to you, and then you benefit from that. So it was reasonable, I thought, that the ratio would start working its way down to the lower end of the channel. But that couldn't have been more wrong. And also, if you look at the RSI of this ratio, it was moving lower while this was moving higher. So it seemed reasonable that, hey, this could start moving lower. Tech has had a great run in 2023 and into 2024. You would maybe think that the rest of the market might start to catch up. And for a while, from February onward, the laggards did outperform tech. And I think in April, as the market was falling, many sectors and industries had outperformed tech up to that point through 2024. But starting in mid-May, the ratio of QQQ to IWM just went vertical, basically. It just, over a 26-day period from, I think, May 10th to June 14th, the Nasdaq 100 outperformed the Russell 2000 from open to close on 22 of 26 days. That's an all-time record. Even during the dot-com bubble, when the Nasdaq trounced everything else as well, it never had a period where it outperformed the Russell 2000 from open to close on 22 of 26 days. The previous record was 20 days. And in 20 out of 26, and this was 22 out of 26, and I'm using the ETFs. If you actually look at the indices, so NDX and RUT, it was 23 out of 26 days where the Nasdaq outperformed the Russell from open to close. So that's historic outperformance. If you look after the May CPI report, this ratio hit a low, and then it hit a high on June 16th, somewhere around there. That was a Sunday. This is the 14th. This must have been 17, 18, 19. So you call it June 19th. At that point, it had outperformed the Russell 2000 by 13.62% in a little over a month. So basically, outperformed by 13.6% percentage points over 20, 27, 28 trading days. It's just crazy outperformance. We've only ever seen that type of outperformance during the dot-com bubble, and it completely unwound. It all unwound when the dot-com bubble burst. So this is the update to that ratio chart. It's broken higher than this top channel, and will it come back, or will it keep going and then collapse back into the channel? That remains to be seen. So other interesting charts, we see that the top 7 stocks are 31% of the S&P 500 in market cap. I think the top 10% of the market is like at a level that was last seen at the Great Depression. So right before the market fell off a cliff. So we have really extreme concentration in the market with the top stocks. This is the Nasdaq versus the Nasdaq Advanced Decline. They were tracking pretty well, but lately, or actually since 2021, The Nasdaq advanced decline has just been moving lower, while the Nasdaq since the end of 2022 has been, actually, yeah, it's the end of 2022 leading into 2023 has been moving higher. That's a pretty extreme divergence. NVDA plus Microsoft plus Apple last week were worth more than the entire S&P 500 in September of 2011, which wasn't a market low. The top 7 stocks were worth more than the entire S&P 500 in February of 2016, which also was not a market bottom. So the size of the largest stocks is just incredible relative to the rest of the market. And in order to do that, these companies had to take on valuation ratios that are really outside their historical norm. If you look at NVIDIA, for most of its life, it's had a price to sales ratio less than 5. So is Apple, so is many of these other mega cap tech stocks. Like, 5 is a pretty high price to sales ratio, and for a long period of time, those assets traded below a price to sales of 5. Now, NVIDIA has a price to sales about 40, and Apple, I think, has a price to sales of almost 9. Microsoft has a price to sales of 14. Now, of course, people will say, well, they're going to grow enormously because of AI. Well, we'll get to that, and there are some experts who say that's not the case and that it's likely going to end badly. So we'll see how that shakes out. The market is at a level where we have, excuse me, bubble level valuations, which are likely not to sustain. So I would probably cast my vote in the sense that it won't end well, and that those valuation ratios will have to shrink enormously in coming years. Speaking of Apple, so from the last call, we had, for a long time we've tracked this pattern where it looks like this was a big bull flag, and it broke out, and if this distance here, if you add it to this point here, would take Apple to 250. That would be the technical pattern if that played out. In our last call, we said Apple has been weak, but we wouldn't be surprised if it led the market higher, if the market had a second leg higher. So this update was given in like the 3rd week of April when the market was bottoming. And it wasn't clear whether it was going to continue to go lower or whether we'd have another leg higher. And the thought that we had was that if we do have another leg higher, we thought that Apple might lead it simply because of this technical pattern. The fundamentals look bad, but even though the fundamentals look bad and negative news was coming out all the time, Apple really couldn't go much below 170. It just kept hanging around 170. So it seemed like someone was accumulating, and it likely was a smart money, because if you look what Apple's done since that time, it's basically gone straight up. So it had earnings and it went up to the low 190s, and then it just kept going up week after week after week. After the Worldwide Development Conference, which on the day of the conference, Apple finished down 2% because people weren't really jazzed up about what they had to offer. But the next day, they started to do the buybacks, and it went up, I think it was like 10% or something like that, maybe 7, 8, 9%. The next day, it was up another 5, 6%. So it was up like 13, 14% in 2 days. It pulled back a little, but today it was up again. This is a weekly chart, and it's at 214, which is not all that far from 250. That's about 15% return for a stock that can move 3-4% a day. It seems like a decent bet that Apple will continue into the mid 200s. Maybe that will be the ultimate top. We'll have to see. But now let's talk about NVIDIA. So NVIDIA obviously has an enormous effect on the current market. I found this chart to be interesting. Berkshire Hathaway is 100 and some years old. Warren Buffett started there 60 years ago, and it's not even a $1 trillion company at this point. And NVIDIA, it took it only 30 days to go from 2 trillion to 3 trillion, and Berkshire Hathaway has been in existence for 135 years, and it's not even $1 trillion. So that kind of puts things in perspective. And there are people who think NVIDIA could go to 5 trillion, and it actually might, and we'll talk about that in a second. But insiders are selling at NVIDIA. So this red chart that looks like a drawdown chart shows how much insiders have been selling, and every time they've sold more than 150 million, NVIDIA's kind of paused, gone sideways or even down. Here, they've sold way more than 150 million. They've sold almost 450 million in insider sales. So will NVIDIA buck the trend and keep going higher, or will it start to consolidate and potentially go lower? Remains to be seen. Now, in our last video call 2 weeks ago, our video update, we said there was a phantom tick in NVIDIA. So phantom ticks are prints that show up on charts, but the market wasn't trading at that level. So on June 11th in the morning, NVIDIA was around 120, and there was this phantom tick at 195.95. And the market lore is that these phantom ticks are signals between market makers that show where the market's going, where they're going to take the market, where the asset's going to go, maybe where they need the asset to go to be made whole because maybe they got left holding the bag. So on June 11th in the morning, this phantom tick was at 195.95. NVIDIA was roughly around 120. It was at $3 trillion market cap. If it goes up, near to 200, that would be a 66% increase. A 66% increase on 3 trillion would be another 2 trillion. So 3 trillion plus 2 trillion is 5 trillion. So if it makes it up here, it would be roughly a $5 trillion company. Now, on the same day that this phantom tick printed, I got this notice on my phone from investing.com that said that this investment group sees NVIDIA market cap hitting 5 trillion in 2025. So I don't know if that was a complete coincidence or if there's something nefarious afoot, but if NVIDIA made it to 200, that would be really incredible. A $5 trillion company, that the mania would just be off the charts. I wouldn't dismiss it as a possibility, but there are several people and investors that think NVIDIA will end badly. So the other day there was an article on investing.com about a prominent technology fund that manages $13.5 billion. They're reducing its NVIDIA position. And their argument is that 60 to 70% of NVIDIA's revenues come from the top 10 customers. And of those top 10 customers, three of their largest customers, Microsoft, Google, and Meta, are aggressively designing their own GPUs to compete with NVIDIA, or maybe not to compete with NVIDIA, but just not having to buy off of NVIDIA. We're going to make these in-house, we're going to design them in-house, have them made, and we'll pay much less than we'd be paying NVIDIA for these chips that we design ourselves. And they'd probably be more efficient for their own needs because they would design them to be that way. Intel's also trying to compete with NVIDIA. They have a chip out that's half the cost of NVIDIA. Huawei in China, I'm not sure if I pronounced that right, but they're also looking to have cheaper GPUs than NVIDIA. So it's likely that NVIDIA's 75% margins will not survive because you have this competition that's looking to aggressively eat into those margins and take some of that away from NVIDIA. Another reason why NVIDIA could be in trouble, medium or longer term, is that they're actively investing in AI startups. Those AI startups take the money that NVIDIA invests and they turn around and buy NVIDIA chips. But if those startups don't achieve profitability, then NVIDIA will lose both its revenue from those startups and also the capital that they invested in them. So NVIDIA could have double losses in that sense. And furthermore, NVIDIA exists in a closed system, the global economy. So it's not possible physically, mathematically, logically for NVIDIA to grow it greater than 20% per annum in perpetuity if the economy is growing at 5 to 6% on a nominal basis. At some point, NVIDIA's growth will have to stall out and potentially reverse. And if margins shrink, if they lose some of their top customers because those customers are getting their chips from stuff that they design themselves, if the AI startups that they're funding don't pan out and thus they lose that revenue. So there's many avenues in which NVIDIA can lose its revenue in the coming years. And then we have these two, so we have an MIT professor, Darren Acemoglu, and Goldman Sachs head of global equity research, Jim Covello. Both have fairly dim views of AI's potential and profitability. So I'll summarize that here, but on the following slides I actually have visuals that show their arguments in more detail, and I'll just kind of let them stay on the screen for a few seconds if you want to read them yourself, but I won't go over them. So I'll just go over the summary here. So the MIT professor says that we won't see any transformative changes quickly, and it'll probably take at least a decade if we even get there. Covello at Goldman Sachs says that AI technology is expensive, and to justify the cost, it's extremely expensive, and in order to justify the cost, AI has to solve complex problems. But it's in its current state, large language models, it's not designed to solve complex problems. Asimoglu sees only 0.5% cumulative productivity boost and 0.9% cumulative GDP boost over the next 10 years. So that's almost nothing. That's pretty minuscule on a cumulative basis over a decade. Covello says that replacing low-wage jobs with tremendously costly AI is the polar opposite of previous technological transitions. He's also skeptical about its transformative potential, as well as skeptical about the costs and being able to get a return on investment for those costs. One of his contentions is that humans have the ability to think outside of the historic sample size and to imagine scenarios that haven't happened, whereas the AI models are trained on data and thus are pretty much confined to only thinking or giving solutions in the existing sample set. Now, you could probably feed it simulated data that takes into consideration humans' imagination about what might happen, but still, it will only be confined to making decisions based on what it's fed in, whereas humans don't have those constraints. We have imaginations. We can think outside of what's actually occurred. So he doesn't think that AI will be smart enough to make employees smarter, and doesn't think it'll be able to really achieve artificial general intelligence. He also says that overbuilding things the world doesn't have use for or is not ready for typically ends badly. Then he mentions the Nasdaq declined 70% from its highs of the dot-com boom until Uber was founded. So we'll go through those slides. I'll let them up on the screen for a few seconds if you want to pause the video to read what they have to say, but that's basically the summary of what they have to say. Okay, now valuations are rapidly approaching a bubble. So the last time I gave this market update, the aggregate investor allocation to equities was at 0.489. That was, I think, April 24th, I think, was the last call. As of today, or yesterday, the aggregate investor allocation to equities was at 0.505. So it went from 0.489 to 0.505. That's a difference of 0.016. If it makes that same leap again, it will be higher than the everything bubble, which was 0.0518, which is only 0.013 away. And if it goes up 0.016, as it did from April to now, we would be right just below the levels at the dot-com bubble. The reason why I look at the aggregate investor allocation to equities is because it has a very high correlation to subsequent returns. So the blue line is the forecasted, the yellow line is the actual return of the market. It's adhered to that blue line quite well. It diverged here in 2021 when Jerome Powell opened the monetary spigots and just flooded the world with cash. But you can see that it's starting to converge again with the blue line. In 2022, it kind of made a beeline lower. Secular bull markets start when the expected return is double digits. The great financial crisis, the expected return at the bottom there was 15.9%. We actually annualized 16% from 2009 to 2019. In 1982, This was at 18.9. That's when the market basically started the secular bull market from 82 to 2000. At the dot-com bubble, the expected 10-year return was minus 1%, and we annualized something like minus 3%, minus 0.5%, excuse me, minus 0.3 or minus 0.5%, so it was very close to minus 1%. At the top of the everything bubble at the end of 2021, this was forecasting minus 0.3% annualized returns over the next decade. So here, this is the latest on the right. We're now expecting 0.7% annualized from here over the next 10 years. That's not where secular bull markets start. That's why I think we're in a secular bear market, and that current valuations won't be sustainable, and that equities will struggle at some point going forward. On the left, we have the expected equity risk premium from April 24th. On the right, we have the current one. So it was at minus 3.1% at the time, which means that the equity return minus the 10-year bond yield was minus 3.1%. Now it's minus 3.5%. So equities are even worse off relative to bonds now, would suggest that even if equities, so the variation around that 0.7% estimate is historically has been around plus or minus 2 percentage points. So you're looking at minus 2% to minus 1.3% to 2.7%. So even if equities come in at 2.7% annualized, they're still 1.5% lower than the current 10-year bond. So it's quite likely that long duration bonds will outperform equities over the next decade, and those are currently priced to probably not outperform inflation, because inflation is likely going to annualize between 4 and 6% over the next decade. So that's why real assets like gold, commodities, gold miners, etc., will likely outperform, because those assets can hold their value during inflationary periods. They tend to they're like a release valve that allow investors to earn a real return when equities aren't providing a real return. So that's one of the reasons why those assets are likely to be very attractive over the remainder of this decade at least. So here we have an asset class overview, dollar, equities, bonds, commodities, gold. So if we look at the dollar, the smart money is bearish on the dollar. They've been bearish for a few months now, but they've recently been buying the dollar aggressively relative to retail traders, and dollar relative sentiment is now in a position that it could turn bullish at any time. So, for much of the last few months, it was quite far from turning bullish, but now it's close enough to the bullish demarcation line that if they continue to buy aggressively, dollar relative sentiment will likely flip bullish. Ultimately, the U.S. fiscal situation will demand negative real rates, which will demand dollar weakness. But when you look at the rest of the world is a mess compared to the U.S. The yen in Japan is just getting trounced. Europe's not doing well. Europe's cutting interest rates, whereas the Fed is still on hold, so that interest rate differential makes the dollar more attractive. So the dollar has a lot of forces that are conspiring to keep it strong, but ultimately the U.S. fiscal situation is going to demand negative real interest rates. Otherwise, it'll be hard to sustain our current debt load and the deficits and servicing that debt. Equities. So composite relative sentiment has been neutral bearish for the month of June, but it will be turning bullish at the end of this week. Institutions have been buying equities. Speculators and retail have been selling in the futures and options market. July is seasonally bullish. June, July, and August are the three most bullish months during election years. So there's reason to believe that we could go higher, but the higher we go, the worse valuations get. So at some point, the music will probably start playing. Long duration bonds, on the last call, we said that they may see a tactical rally, and that's exactly what we've seen. But long term would avoid them like the plague, because inflation is likely going to annualize more than what those bonds are currently yielding. Now, if they start to yield 6 or 7%, which probably won't be allowed by the Fed, they'll probably have to suppress rates through yield curve control if rates were to rise at that level, because that would probably completely bankrupt the U.S. government. But unless the yields are at that level, Probably doesn't make sense to own long duration bonds over the long term, but we have seen a tactical rally, and positioning was such that we thought that could be the case, and that actually did turn out. But positioning for bonds, long duration bonds, is going to turn bearish next week. So while they might still rise because anything could happen, they will be fighting a headwind, a positioning headwind, in order for long duration bonds to continue to rise from here. Commodities, the big picture on commodities is that they're bullish, but from our last call we mentioned that the White House may want to suppress oil in the medium term, and oil did peak in April, and then it's been pretty much downhill since then. It's rebounded a little bit recently, but nowhere near its high from April. And Biden did say that they would release gasoline from reserves to bring gasoline prices down, and gasoline prices have come down. So in the near term, commodities still might be choppy and not have much direction, but if you zoom out and look at the chart, from a big picture perspective, it's bullish. If you look at the secular cycle that we're in, very bullish for commodities. So if there are any material sell-offs, it might be a good time to add exposure to commodities if you don't currently have it. With respect to gold, so up until a couple weeks ago, gold positioning was favorable. Gold, silver, and miners went on big rallies. It looks like they may have peaked. They've been going sideways down since May, April, and now positioning is unfavorable for gold and silver and miners. They're also fairly stretched above their long-term moving averages, so it's possible that we could see a sharp pullback in those assets to kind of reset sentiment. Retail's been buying, institutions have been selling. We probably have to see retail capitulate and institutions start to buy again before gold, silver, and miners can have a second wind and move higher from here. So just looking at some charts of those asset classes we just touched on, dollar relative sentiment turned bearish here. It went down, but then it rebounded very strongly. And when it rebounded from mid-March to mid-April, late April, equities sold off. Equities peaked in mid-March. They bottomed on April 19th. So like over this month period, the dollar rallied and stocks fell. Then the dollar started to fall, and equities bounced from April 19th into May. The end of May, equities rallied. Now the dollar's rallying again, and while the S&P 500's up, it's mainly up because of the top 3 to 7 stocks. But if you look at the Russell 2000, if you look at Japan, China, if you look at European stocks, if you look at energy stocks, you look at the equal weighted S&P, mid caps, they're all down on the month, 1 to 3%. And that's probably because of this dollar rally that's weighing on those stocks. Now, will the dollar turn around anytime soon? It remains to be seen. We have the PCE coming out on Friday. We have another inflation report in mid-July. The Fed will meet at some point. So perhaps the dollar does weaken and relative sentiment in the dollar is bearish, but as we mentioned, smart money's been buying that dollar aggressively on a relative basis, so that could flip bullish. And if it flips bullish, then I wouldn't necessarily count on the dollar weakening. But in order for things to kind of operate smoothly, for the bond market to function, for equities to continue rising, you probably need a weaker dollar. The rest of the world isn't making it easy because they're in worse shape than we are, so naturally the dollar attracts flows relative to those currencies. So this is something that we're going to have to watch and see how it plays out. But current state is dollar relative sentiment is bearish, dollar's been rising, I guess smart money's been buying. Here's a visualization of the smart money buying. So the yellow and blue lines are moving towards the 0 line, which is this is the Z-score of relative positioning between the smart money and retail traders. If it goes above 0, that's bullish. If it's below 0, that's bearish. It's heading, it looks like, towards like it could go above 0, but there have been many times in the past where it's done something similar and it's kind of stalled out before actually turning positive. So we'll have to see if it actually does turn positive. That would actually call into question whether or not the rally had much longer to survive. Because when the dollar is bullish, the dollar tends to rise, at a decent clip, and that could really put a crimp in the market. As you see, the dollar has actually been rising, even though dollar relative sentiment is bearish the last, this month of June, and most stocks are going lower. So it would be, I think the top 3 stocks, top 7 stocks, would be hard pressed for them to continue to rise if the dollar continued to rise. So we're likely going to need a weakening dollar for the rally to continue materially higher. So we'll see how that plays out. With respect to equities, so for the month of June, composite equity relative sentiment has been less than 50. It's been in the 40s, and then recently it dipped down to 37. Those are neutral bearish readings, which, in light of the fact that the S&P has rallied 3.6%, it might seem like it was an unwarranted signal. But if you kind of scratch the surface, you see that Europe was down 2%, developed market stocks down 2%, equal weight S&P down 1%, Russell 2000 down almost 3%, China flat, Japan down almost 2%, energy stocks down 2%, industrial stocks down 1%, mid caps down 2.5%. If you look at the advanced decline line, it's going lower, the cumulative advanced decline line. So more stocks have been going down on a day-to-day basis than going up, even though the S&P's been rising. And the S&P's been rising because the top 3 to 7 stocks have been going up. But virtually everything else has been going down. So this was actually a signal that was not totally unwarranted, and it did have us underweight Europe and developed market stocks, which fell. So that was a positive from that situation. But at the end of the month, this will be jumping up into the 60s, so it will be turning bullish again at the end of this month. And it will be jumping into this 60 to 80% bucket, which is this light green line here, which you can see has done quite well over the last 30 years. This bucket here, 60 to 80%, the market annualizes 20% returns when composite equity relative sentiment is in that bucket. It has a Sharpe ratio of 1.3. It's not as good as when composite equity relative sentiment is above 80, where the Sharpe is 3.3. That's this dark green line where it basically just goes up or sideways, up or sideways. This light green line has basically drifted up. It's had a drawdown of 15% over that 30-year period when equities have been in that bucket, but for the most part, it's been a pretty solid time to be long equities. So we'll be in that bucket come the end of this month. July, we're leading into July. July is historically very bullish. I think the S&P is up 9 Julys in a row. The Nasdaq's up 16 Julys in a row with an average of 4.6% return. That's pretty crazy bullish. We'll see if it can do the same this month or this year. But we definitely have relative sentiment and the positioning of institutions versus retail kind of favoring the market from here. However, volatility is very low, implied correlation is very low. So if you look at the volatility of the market as a whole, it's low. But if you look at the volatility of individual stocks, it's not so low. And the fact that individual stocks are much more volatile than the broad market says that the correlation between those stocks, the implied correlation, is very low. The stock goes up, another stock goes down, they kind of cancel each other out, the broad market doesn't move. But this is the lowest the implied correlation has ever been on record, and so it's reasonable to think that at some point that will snap higher when all stocks start moving in concert with one another, and volatility will likely rise at that point, and that might mean that equities go lower. So it might not be smooth sailing, and I could see a near-term sell-off if the rest of the market doesn't start to move higher, because it's probably likely that the top 3 to 7 stocks will need a breather, get a little bit tired, a little bit exhausted, and have to either go sideways or pull back. And if the rest of the market isn't rising, then the broad market is likely to pull back. So I could actually see that happening, with the dollar rising, long duration bonds rising, gold outperforming silver and miners, commodities being weak, most of the market other than the top few stocks going down. That kind of is suggestive of a risk-off episode, and that might actually become amplified if the top stocks also start moving lower. So I could see a near-term pullback, but we still have several months until the election. I would imagine that the Fed, the Treasury, and the White House would do whatever it takes to stop the market from selling off too dramatically and try to get it rising again as we move into the election period. And if relative sentiment is bullish, that would also suggest that the market has tailwinds that would likely stabilize it at some point as well. So this is a slide about bonds from our last call. Bonds were actually moving lower at the time. This is TLT. We've said that Yellen will be happy if bonds started to go higher. If they started to go lower, she'd be unhappy. Now at the time, positioning in long duration bonds was starting to turn bullish, and we thought it was possible that we'd have a tactical rally in bonds, and we pretty much have had that tactical rally. Now this is TLT, and this red line, TLT is having a hard time staying above that red line. That red line actually corresponds to a 30-year bond yield of 4.45%. So that seems to be a magnet. Every time it's gone below 4.45% in the last week or two, it keeps coming back up to 4.45%, and it was having a hard time going below that before it did break below it. So, TLT came up here and touched this red line. 30-year bond yield came down and touched 4.45. TLT fell, 30-year bond yield rose, and it came back up here, paused again, finally broke through, TLT did. 30-year bond yield went below 4.45%, but as of today, it's basically back at 4.45%. And it's hanging out at 4.47 right now. So the tactical bond rally might be over. This looks like it's forming a little bit of a rising wedge, which tends not to be bullish. And positioning in long duration bonds, as we see here, will be turning bearish. So the blue line is composite relative sentiment in TLT. It's currently above 50%, which means it's bullish. But the spot relative positioning, which is where this blue line ultimately moves to, is very negative. And I believe next week this blue line will also be below 50%, meaning that composite relative sentiment in TLT will be negative. And as you can see, when it's been below 50%, TLT sold off here, went flat here. So three winning signals and one scratch. When it's been above 50%, we have a winning signal here, a winning signal there, a winning signal there. Here's one that's pretty much break even. So this has been a decent indicator of when to be long and when not to be long TLT, and it's basically saying that as of next week, you don't want to be long. So that tactical rally in bonds might be coming to an end. But if it doesn't come to an end, we can say that the bonds are essentially fighting a headwind of negative positioning. Here are commodities. So this is a weekly chart. It's zoomed out. At this low here, oil was negative. I think that was April of 2024. Oil went negative on its expiration. Nobody wanted to buy it. They didn't have room to store it. There was such a glut because of the COVID pandemic. So they were paying people to take it, off of them. So the price went negative. But that was basically the end of the secular, decade plus long secular bear market in commodities. Now we're in a secular bull market. And this chart looks like it could be a cup and handle. So we would expect this to eventually work its way up to here and keep going higher. This looks like a cup and handle within a cup and handle, and possibly another cup and handle within a cup and handle. This potentially looks like a bull flag. So, there are many bullish interpretations of this chart. The secular cycle is very supportive of commodities. We may see it continue to consolidate and kind of chop around, given that commodities rising would not be good for inflation leading into an election. So, as the Biden administration said, they would do whatever they could to get oil prices down. It looks like they've done that. So I would expect that to let up between now and the election if oil starts to rise again. So now might not be the time to really go super long commodities. But if there are any material sell-offs, it's probably a good time to add exposure given the secular cycle that we're in. Gold. So positioning is no longer favorable for gold. I don't have the chart that shows composite relative sentiment, but composite relative sentiment turned bullish about right here, and it caught this rally here, but as of this point it turned bearish. Gold has started to drift lower. This looks like it could be head and shoulders. Here's where it broke out from after multiple tests over multiple years. Here's the 200-day moving average. It wouldn't be crazy, given that positioning isn't favorable, given that it's way above its 200-day moving average, way above the level that it broke out, and things tend to come back and test the breakout level. It wouldn't be crazy for gold to come down to this is the GLD ETF, but I think this level is probably around 2,200 on the gold futures and spot gold. So that would be sort of a convergence of the breakout level and the 200-day moving average if it made it to somewhere around here. And that would also likely let institutions, which on a relative basis are bearish relative to retail traders, they still have an absolute net short position. And on March 27th, JP Morgan, which is one of the big dealers that has a large net short position, visited the Shanghai Gold Exchange. And then, lo and behold, as of the end of April, the Chinese central bank paused its gold accumulation. Perhaps a deal was struck where China will pause its gold accumulation to let JP Morgan out of its shorts. JP Morgan will probably flip, relatively bullish somewhere down around here as retail is throwing in the towel because they were buying up here and now they've lost 10, 15, 20%. And so that will probably be the time where gold then takes off again on another leg higher. So with respect to preferred positioning, so this is a slide from the last call. This was April 24th. The thought was that we should scale into the dip that bottomed on April 19th. We thought that maybe it could go lower, but composite equity relative sentiment was bullish, and a rally to higher highs seemed likely, even if it did go lower from that point. But we also said we preferred uncrowded trades, small caps, energy over crowded ones, tech. And that was wrong. That was very wrong. Although we did say that the laggards, XLE and small caps, had strongly outperformed tech from February to late April. So that maybe those laggards would take a breather, but we certainly didn't envision the breather that they've taken relative to tech. As you saw at the outset, IWM has underperformed QQQ by 13.6 percentage points over just a month period, from the middle of May to the middle or third week of June. So definitely didn't anticipate that much of a breather taken by the laggards. So that call was wrong. Scaling into the dip was right. Thinking that the laggards, which had started to outperform, would take a breather. That actually played out, but definitely didn't expect the massive outperformance of the Nasdaq 100. Bonds, we said that we preferred short duration tips and nominal bonds, but we said beware of a long duration rally if Yellen excites the market with the schedule of Treasury issuance, which was happening the week after this presentation. We did get that long duration rally. We also said that inflation sensitive assets have done well, still great long term, but may consolidate in the near term. And that's what we've seen. We saw that oil, commodities, and gold have gone sideways or lower since April. So for the most part, with bonds, inflation sensitive assets, and the idea of buying the dip, that was on the mark, but really got the sector distribution wrong. QQQ massively outperformed, so that was a losing call. Now our preferred positioning, we think it's possible that we may have a near-term sell-off if the rest of the market doesn't start moving higher, and it may not be able to move higher if the dollar continues to rise. Medium term, we don't think we've topped yet, and we think it's hard to imagine the market continuing to move materially higher without more participation from everything outside of the top 7 stocks. Thus, we do still think that we could have some type of a catch-up trade. Now, we're not saying that IWM and the laggards will completely catch up to tech, but they might start eating away into that large margin that tech has basically, created versus those other sectors in the last month. So we do think there might be some convergence there, simply because we think the market will ultimately move higher, but we don't think it can move materially higher if the rest of the market doesn't start to participate. It would seem to be a big ask for the top 7 stocks to continue to carry the market after they've been up so much as it is. And as time passes, it's possible that people will start to think, well, AI might not be everything it's cracked up to be, and so you might start to see some selling into those large names, and actually that's what we've been seeing. Hedge funds have been heavily selling tech stocks to retail investors the past few weeks, and it's the heaviest such selling on record. So we might be at that point already. So medium term, we think that the market goes higher. We do think that tech could take a breather and that the laggards could start to close the gap a little bit. I don't think it'll close all the way because it's a huge gap. But from this point forward, we would expect, we certainly wouldn't expect the type of outperformance that we've seen from tech relative to the rest of the market. And we'd actually think that the rest of the market might start to slightly outperform tech from here. And we think that's probably necessary for the market to continue to go higher. Now, there's one caveat. In 2007, the market was rallying, but financials were lagging. I think by the middle of the year, financials were down 20%, but the market was up decently. And the thought was that, wow, when financials catch up, when they go from -20 to 0 and then +10, that's really going to turbocharge this rally, and the market's just going to keep going. But that didn't happen. The market peaked in October. Financials never got any better. They only got worse, and that led into the great financial crisis. So there is precedent for the laggards not to catch up. So, I'm keeping that in mind. And the fact that the market has been trading in a very risk-off way, dollar up, long duration bonds up, stocks down, commodities weak, gold outperforming silver and miners, that also makes me think that it's possible that these laggards might not catch up and that we might be heading into something nasty on the horizon. We'll have to see how that plays out. I don't think that's necessarily the case. I don't think the nastiness is imminent. I eventually think we will run into something like that, and that equities will pull back dramatically given where valuations are. But I don't feel like it's imminent, so I do think the catch-up trade might outperform over the next, say, 6 to 12 weeks. With bonds, again, continue to prefer short duration tips and nominal. We've had a decent long duration rally. Positioning is now turning bearish for long duration. Of course, I don't foresee interest rates rising too vigorously as they did in the third quarter of last year, which caused a major sell-off in equity markets. I think they'll try to keep a lid on that. I think Janet Yellen, spending down the TGA, flooding the market with some liquidity, it keeps bond volatility lower. All else equal, it weakens the dollar. I think she has a pretty big, war chest there at the Treasury General Account. She probably hoarded the cash precisely for this reason leading up to the election. So I don't necessarily foresee long duration bonds and the 10-year bond falling, precipitously at this point, but it might struggle to go a lot higher unless the Fed is able to raise rates because the next inflation report is really favorable. So I think a lot of it hinges on the economic data that we have in the next few weeks. Inflation sensitive assets, they've consolidated, but they may have a hard time rallying unless the dollar starts to weaken. I definitely would not be pressing longs in gold, silver, and miners because the positioning is turned bearish, and you definitely don't want to be long silver and miners when the positioning is bearish. Sometimes gold kind of treads water, goes sideways. Not necessarily the end of the world when positioning is bearish. The last time it was bearish, or one of the last times it was bearish, gold chopped around sideways, silver fell, miners fell pretty hard. I would wait until positioning once again turned favorable, which probably requires them to go sideways for a while or pull back significantly to those support levels that we had talked about before positioning again would turn favorable. However, given that the secular forces conspire to support these assets in the long term, the inflation-sensitive assets, if we do happen to see any material sell-off in those assets over the next, quarter or so, it would probably pay handsomely in the long run to buy those assets. So that's the update. If you have any, actually we have a summary, but so again, we're in a secular bear market driven by high inflation. Inflation appears to be cooling for the time being, and conveniently as we lead into the election. But the market's been trading like it's worried about growth, recession or deflation, dollar up, rates down, stocks, commodities down, gold outperforming silver and miners. In order for a broadening of the rally, we likely need the dollar to weaken. That could be hard because the rest of the world's a mess. Equities are near bubble territory, but the rally is probably not over as there's still several months until the election. Composite equity relative sentiment is bullish and seasonality is too. But for the market to move materially higher, one would think that Max 7 can't do it solely by themselves. Thus, we would expect a broadening of the rally and some type of catch-up between the rest of the market and the Nasdaq at some point. However, there is precedent for the laggards not to catch up. That happened during the great financial crisis with financials. So that's the update. If you have any questions or comments, leave them in the chat. I'll be happy to answer them. Thanks for watching, and until next time, best of luck.